In 2021, thousands of investors lost millions in a crypto scam that blocked withdrawals overnight, leaving users unable to access funds they believed were fully under their control. Platforms showed growing balances and steady returns, and users continued investing as profits appeared to increase within their accounts. Money moved into these systems through crypto transfers, and once funds entered, users were told withdrawals would be processed after verification or additional deposits. Reports began to surface where users attempted to withdraw funds and accounts were suddenly restricted, locked, or marked for review without clear explanation. The scam relied on controlled access, where deposits were always accepted, but withdrawals were delayed, limited, or completely blocked. Similar large-scale investment scams have affected thousands globally, with billions lost, and in extreme cases, financial collapse has led to severe personal consequences for victims. Investors continued funding accounts to unlock supposed profits, believing additional payments would release their balances. At its peak, the system operated without interruption, and most users had not yet attempted withdrawal to verify whether the funds were real. What appeared to be profitable crypto investment platforms was actually a scam where deposits were real, but withdrawals were never meant to happen. That system began expanding rapidly in 2021 across global crypto markets, where platforms operating online attracted users from multiple countries with promises of steady returns and easy access to funds. In regions across Asia, Europe, and North America, thousands of investors entered these platforms, transferring cryptocurrency into accounts that displayed consistent growth over time. A comparable situation was seen in large-scale crypto investment schemes such as BitConnect, where reported returns attracted massive participation before underlying operations were ever verified. Users relied on platform dashboards showing profits, and account balances increased in real time, creating confidence that the system was functioning legitimately. Money flowed into these platforms through direct crypto transfers, and users treated their balances as accessible funds rather than controlled entries within a closed system. Verification of platform operations was limited, and most users did not attempt withdrawal early, allowing the system to grow without immediate scrutiny. Large numbers of participants allocated savings into these platforms, expecting returns based on displayed performance rather than confirmed liquidity. The structure depended on continuous inflow, where new deposits supported the appearance of growth without proving the existence of actual underlying assets. This environment allowed the crypto withdrawal scam to scale globally, where trust in displayed balances replaced the need to verify whether funds could actually be withdrawn. That global inflow created the opening where operators positioned these platforms as accessible investment systems, and users deposited cryptocurrency expecting immediate control over their funds. Platforms advertised fixed daily returns and referral incentives, and users increased deposits as on-screen balances appeared to grow consistently. A comparable structure was seen in schemes like OneCoin, where reported value and controlled messaging attracted participants before any real liquidity was proven. Each deposit was converted into platform balances, and users treated these figures as withdrawable assets rather than entries managed by the system itself. Money moved through direct wallet transfers, and once funds entered, users relied entirely on the platform's internal controls to access or move their assets. Decisions escalated as participants reinvested profits, shown on dashboards, invited others, and allocated additional savings based on perceived performance. The opportunity depended on delayed verification, where most users did not test withdrawals early, allowing confidence to build without proof of liquidity. Operators expanded the system by onboarding new users, increasing deposits, while maintaining full control over outflows. This gap between visible balances and actual access created the opportunity that allowed the crypto withdrawal scam to expand. As deposits continued to increase, the crypto withdrawal scam operated by separating visible balances from actual liquidity, where users saw profits while access to funds remained fully controlled by the platform. Platforms displayed real-time gains and transaction histories, and users interpreted these updates as evidence of active trading or mining operations. Withdrawal requests were processed selectively at first, allowing small payouts to build trust, while larger amounts were delayed or restricted. Money moved one way into the system, and outflows were managed through internal rules that could be changed without notice. Operators introduced verification steps, fees, or minimum thresholds, requiring users to deposit additional funds before withdrawals could be approved. Decisions followed these conditions, with users sending more cryptocurrency to unlock balances they believed already belonged to them. The system relied on controlled trust, where visible activity replaced proof of actual reserves or liquidity. Because transactions occurred within the platform, users could not independently confirm whether funds were held or available outside the system. This mechanism allowed the crypto withdrawal scam to function as a closed loop, where deposits were real but withdrawals were governed entirely by the operators. As deposits continued to increase, the crypto withdrawal scam operated by separating visible balances from actual liquidity, where users saw profits while access to funds remained fully controlled by the platform. Platforms displayed real-time gains and transaction histories, and users interpreted these updates as evidence of active trading or mining operations. Withdrawal requests were processed selectively at first, allowing small payouts to build trust, while larger amounts were delayed or restricted. Money moved one way into the system, and outflows were managed through internal rules that could be changed without notice. Operators introduced verification steps, fees, or minimum thresholds, requiring users to deposit additional funds before withdrawals could be approved. Decisions followed these conditions, with users sending more cryptocurrency to unlock balances they believed already belonged to them. The system relied on controlled trust, where visible activity replaced proof of actual reserves or liquidity. Because transactions occurred within the platform, users could not independently confirm whether funds were held or available outside the system. This mechanism allowed the crypto withdrawal scam to function as a closed loop, where deposits were real, but withdrawals were governed entirely by the operators. As more users attempted withdrawals, delays increased noticeably, and requests that were previously processed began to remain pending without clear timelines. Some accounts were flagged for additional verification, and users were required to submit documents or make further deposits before accessing their funds. Conflicting explanations emerged across platforms, with support teams providing inconsistent reasons for blocked or restricted withdrawals. Online communities began reporting similar issues, and patterns of failed withdrawals appeared across different regions and user groups. Attempts to withdraw larger amounts were denied or limited, while smaller transactions were selectively processed to maintain confidence. Users who questioned the system were told that technical issues or compliance checks were causing delays, and resolution timelines remained unclear. Independent observers and analysts began highlighting discrepancies between reported platform activity and actual transaction behavior. Trust began to weaken as more users realized that access to funds was no longer guaranteed and visible balances did not reflect actual liquidity. These warning signs revealed that the system was restricting outflows, indicating that the crypto withdrawal scam was no longer functioning as a legitimate investment platform. As withdrawal failures spread across platforms, the crypto withdrawal scam came to the surface when large numbers of users were unable to access funds at the same time. Verification attempts intensified as users checked blockchain activity, and many discovered that platform wallets did not hold enough assets to match reported balances. Regulators and investigators began formal inquiries in multiple jurisdictions, reviewing transaction flows and identifying discrepancies between deposits and actual reserves. Public reports confirmed that billions of dollars were involved, and thousands of investors across different countries were affected by blocked or inaccessible funds. Decisions reversed rapidly as users attempted to exit positions, but withdrawal requests remained pending or were rejected entirely. Online communities documented the collapse in real time, sharing evidence of failed transactions and restricted accounts. Authorities issued warnings and alerts, and some platforms shut down operations or went offline without processing remaining balances. Financial losses became clear as users realized that displayed profits and account balances could not be converted into real assets. The crypto withdrawal scam collapsed when verification replaced trust, exposing that deposits were real while access to funds had never been guaranteed. Once the platforms failed, the crypto withdrawal scam revealed a repeatable structure where visible balances replaced real liquidity and access was controlled by the operators. Money entered through irreversible crypto transfers, while withdrawals depended entirely on internal rules that could be changed or enforced at any time. Users relied on dashboards, reports, and rising balances, treating displayed figures as proof of value without verifying whether funds were actually accessible. The system expanded by delaying verification, allowing confidence to build until the scale of deposits exceeded any capacity to return funds. The point of failure occurred when large numbers of users attempted withdrawals simultaneously, forcing the system to reveal that liquidity did not exist at the required level. Real-world outcomes followed, including billions in losses, widespread financial damage, and loss of trust in similar platforms and investment structures. Investigations showed that the mechanism did not require complex technology, only controlled access to deposits and the ability to restrict outflows. This pattern has appeared across multiple modern investment scams, where access to funds is separated from ownership and controlled by centralized systems. The lesson remains consistent. When you can deposit without restriction but cannot withdraw freely, the system itself is the scam.